Hi, I'm Chloe Carruthers here with Barry Norris, the fund manager of the award-winning Absolute Return Fund, here for our September update. Barry, it was another tumultuous month for markets, with equity indices hitting new lows. Why was this?
Well, Chloe, it was all about the Federal Reserve again, continuing their hawkish messaging. They raised their Fed funds rate by another 75 basis points, this time to 3.25%. And I think what really disappointed the market was that the CPI, the measure of inflation most commonly used, didn't fall as much as what they'd been expecting. And also measures of labor strength in the US economy remain very strong. So really without unemployment rising, wage growth isn't going to come down. Treasury yields continue to rise to new cycle highs. So you had the 2-year note touching 4.3% and the 10-year note nearly 4%. And if you think just 12 months ago, those were at 0.25 or 1.5% respectively. And the dollar index also hit its highest level since 2002, putting pressure on other economies around the world. So if you think just 12 months ago, risk assets were being priced using near zero interest rates, now you probably have to stick a 4 in terms of the risk-free rate. And that means that valuations are a lot lower. And in addition to that, with a slowing global economy, there's also risks around earnings, which to date have been buoyed by strong inflation and nominal economic growth.
What did you make of the UK mini budget, and why was there such a negative reaction?
Well, I think, Chloe, that the budget was a political gamble in terms of announcing the top rate of tax, but any fiscal gamble had been made of weeks before with the announcement of the energy bailout. The new information in the budget was relatively modest, so stamp duty and income tax cuts were expected to cost around 0.2% of GDP, whereas the energy bailout could amount to about 10% of GDP. And nobody complained about that when that was announced 2 weeks previously. And of course, COVID, or the response to COVID, probably cost the UK economy about 20% of GDP. So this new information was really quite small beer, and therefore either pundits were asleep the previous couple of weeks, or they didn't do their sums to think that this was by itself causing fiscal instability in the UK. So it came as no surprise to us how quickly the pound bounced back and got over the hysteria, though of course Kwarteng was forced to cut the top rate of tax measure after a week of political turbulence. But if you think that the UK taxes today are really the highest as a percentage of national income since World War II, you can understand how they might want to cut taxes to get the economy going again. And I think what will impact the pound and the UK economy going forward isn't going to be marginal taxation or small ticket items like that. It's going to be the sensitivity to non-quasi-Kwarteng factors, such as the price of energy. And bear in mind, Britain's no longer an energy exporter, and in fact imports about half of its energy. So that's a big factor in terms of the fiscal and the trade deficit. And also, of course, its sensitivity to the Fed hiking cycle. And in particular, the UK, most mortgages are based off short rates and they're floating. So that means that things could get worse if the Fed continue to hike, but probably we're closer to the end of that cycle than the beginning.
Can you give us an update on the energy crisis?
Yeah, so in addition to the UK's generous announcement, Germany also announced a similar measure worth about 200 billion euros, and that's in addition to 35 billion euros that they'd previously announced in terms of subsidizing both business and residential bills over the winter. And that really, if you like, means that there should be less downside to the economy in the short term, but obviously more government debt, and you won't get the same kind of demand destruction. In addition, during the month, the Nord Stream pipelines were subject to sabotage, meaning that Europe will have to start planning for life without meaningful Russian gas, irrespective of who's in power in Russia or what happens in the Ukraine war, probably for a number of years. We also saw some rather encouraging news with the UK government lifting its ban on fracking and encouraging North Sea oil and gas production again. And if you think that Britain's oil and gas production peaked in 1998, and ever since 2004, the UK's been a net importer. So Business Secretary Kwartung, before he was Chancellor, said rather foolishly, I thought, that UK production wouldn't make any difference to the energy crisis because we'd be selling it at the world price. That, of course, ignores the fact that the price of gas in the US has been some 90% cheaper for the whole of the year. So there's no worldwide price of gas simply because the costs of exporting it and transporting it are so high. But also, of course, becoming more energy self-sufficient does wonders for trade and fiscal surpluses when the price of energy is so high. I mean, people in Norway don't turn around and say, oh, perhaps we shouldn't drill for oil and gas this year because we'll have to pay the same price in Norway as we pay for the rest of the world. Of course they don't. The Norway is the richest country in Europe precisely because they are a net exporter of oil and gas, and they have the biggest wealth fund in the world precisely because they've grown so rich as an exporter of fossil fuels. So I think perhaps our Chancellor might want to reconsider his view on that. And of course, in the absence of proper large-scale battery storage or competitive green hydrogen, or indeed unicorns or fairies, fossil fuels are going to remain a key part of our energy production in the UK for the foreseeable future. I think we also have to compare that to Europe, where they've introduced an additional tax on fossil fuel producers, a solidarity tax at about 33% of profits. And for many companies that are enjoying their first decent year in the last three, that means all of their profits. So the idea that that's going to encourage any supply response in Europe to the energy shortage, I think, is for the birds, Chloe. I think we also have to consider that Europe is still importing record amounts of Russian oil, and that embargo only comes in December, and then there's another embargo against refined product in February. So it's still set to be a very volatile winter. And then, of course, all of this is now going to last well beyond the winter into the next few years as well.
How did the fund do over the month? And did you make any changes to the portfolio?
Yeah, so the fund performed resiliently over the month, considering what was going on in markets, falling by less than 0.5%. We're currency hedged, certainly the GBP share class, so we didn't benefit from sterling weakness like some of the long-only funds. And of course, although we're cautiously positioned, it's pretty rare for us to be net short. So we had a lot of winners in the short book, but the long book was generally pretty weak, owing to the market performance and, some of our beta to the falling oil price. I think one thing we have done in the fund is that because, of course, most of our equity investments are held via CFD, we started to make some investments in the UK and the US government bond market, where the yields are considerably higher than the cash yield. And we think that that's going to, or if you like, the government bond market is now offering some value, and certainly more value than cash. And that will help fund returns, hopefully, going forward.
Are there any hopeful signs that the bear market might be coming to an end?
Good question, Chloe. Well, I think for the bear market in equities to end, the bear market in government bonds has to end first. So there's a degree of choreography about this, where people get worried enough about the economy for there to be a bid for government bonds, and then equities go through the if you like, the earnings recession, and then equities therefore stabilize afterwards. So as we say, that we can see that there is some value in the treasury and the gilt market now, but on the other hand, treasuries of the dollar continue to suck liquidity out of global financial markets. Bond futures are pricing another 75 basis points hikes in October, and 50 again in November, and the peak Fed funds rate of, I think, 4.5% by next March. Now, we'd probably now be surprised if we get there, but I think what's unhelpful is simply the number of equity market participants looking for a Fed pivot and trying to anticipate this. The Fed aren't going to turn dovish into a bullish equity market. They're only going to turn dovish after we've had a big crash and something has been broken in the global economy or the global financial markets. And I don't think we're there yet.
Okay, great. Thank you very much for your time, Barry.
Thanks, Chloe.